when you sell the stock of a C corporation to a new owner, whenever you're done with the business, there's a way to exclude up to $10 million of the gain on that sale. The most recent tax law change, the OBBB Act of 2025, individual owners can get up to $10 million of gain exclusion.
Everybody, welcome back to Break Free from Wall Street with Safeguard Advisors, the podcast where we talk about all things alternative assets. And today we have a really great episode because what if I told you that the biggest wealth that you ever build isn't from returns, but it's from what you keep, what you don't pay the IRS. Today we're talking tax strategy, we're talking the behind the scenes leverage that unlocks flexibility, fuel for alternative assets, and a more intentional allocation of your capital. Our guests today, really excited to have them on. They help business owners and investors stop giving money away to the IRS and instead really deploy it where it actually grows. For our purposes, we're talking about beyond public markets, and really, again, grateful and excited to be sitting down here with Caleb and Hope Helps today of Helms Tax Strategy. We're going to be asking them some questions. Caleb and Hope, welcome to the show.
Hi.
Thanks so much, Nick.
Yeah, absolutely. So Caleb, just to give you guys some background, Caleb is a CPA and his partner Hope Helms is CEO and business transformation advisor at Helms Tax Strategy. From what I've seen, a firm really built on proactive, holistic tax planning, advisory services for business owners, investors, and family offices alike. I mean, really, anybody who can use it. Their mission, as I can see it, is pretty simple: help clients avoid unnecessary tax burdens while aligning with financial decisions with deeper goals and really freeing your capital up to do more than just pay the IRS. Is there anything I missed, Caleb? Hope?
No, Nick, that's a great summary. Basically, we try to partner with clients, and just parenthetically, one of the big gaps I see in the accounting profession is communication. That's one of our biggest pain points that clients come to us with. And they say they don't understand what their accountant is doing. They don't understand their tax bill, that kind of thing. So they come to us. And like you said, one of our big goals is to clarify the tax code for our clients so that they don't have as much money going to the IRS. And that goes into other areas of the business as well. So we try to provide more clarity and granularity to the financials so that they understand their financials better and can make better business decisions. We work with them also on CFO fractional services for the right client, of course, to help them understand what the drivers and the metrics are that they should be measuring in their business so that they can take their business to the next level.
That's awesome. That's what everybody's looking to do, is really take that next step. And I think that the ability to have somebody in your corner who can communicate and help walk you through the things that are going to help you get there is really pivotal. I want to dive into, some of your tax strategies, some of your philosophies, but I'd really first like to get an idea of your background and where you guys came from and really what led to you starting this tax strategy firm.
Yeah, that sounds great. My background, I've been a CPA for, goodness, 14 years, something like that. Been in the accounting profession for about 16 years. So been in it all my life, and it's been a mixture of private accounting and public accounting. My wife and I ended up buying an existing accounting firm about 3.5 years ago, and I know we'll go into some of those reasons later in the podcast. But one of the reasons, to your point in this section, is that we wanted to be able to provide more value to business owners. And I saw that there was a gap in the market where at the top end, you have the big four accounting firms and other advisory firms that are informing small to mid-sized businesses. And usually the small businesses can't afford the big four accounting firms. And so then it falls to smaller accounting firms in the market to deliver those services. And most of them are focused on history. And that's not a knock. Sometimes people view it as a knock, but by law, you have to look at the past and see what a person's income was for the year, what their expenses were for the year, and based on that, what they owe in taxes for the year. So most CPAs are historians. They look in the past. That's necessary. But it doesn't allow a proactive business owner to make decisions for his business to, number one, save taxes, and number two, potentially shift his product orientation or his service lines to be more profitable for his business. And so I saw kind of that gap in the market. And one of the reasons that we bought the business was to step in and try to meet some of that need for small to mid-sized business owners.
Yeah, and I think you've kind of segued us into really my first question here kind of perfectly, which was really I've always felt like there is this big difference between being a CPA and being a tax strategist. Do you think that's the main difference? Is that, with a CPA, maybe you're just looking at the past, and you're looking at the task at hand now is filing these taxes and saving those taxes. But with the tax strategist, is it really that future element and planning for future expenses, future business models, whatever it may be? Is that the main difference, as you would see it, between the two?
Yeah, that's a great question. I do think that's probably the biggest difference. Most CPAs, and there's a wide range of CPAs. So, some are in tax, some are in audit, some work for big corporations for their accounting function. For purposes of small to mid-sized business owners, their tax CPA is probably the only CPA they'll ever meet, or possibly an accounting or bookkeeping CPA, or at least work with on an ongoing basis. And yes, most CPAs look in the past. They have to report what's been done, and the business owner gets that to pay taxes. A tax strategist, to your point, and a fractional CFO looks at trend lines and looks at opportunities that may
Mhm.
be on the cusp of being there, but aren't exactly there. And so what I do with my tax strategy clients is I go through and I don't know if you ever read the book 7 Habits of Highly Effective People by Stephen Covey, but one of his habits is start with the end in mind. And
Mm.
that's where we start with our clients. I try to understand where they're going from a legacy perspective, where they're going from an asset ownership
Mhm.
perspective. What kind of assets do they want to own in the future? And we take that and we say, okay, this minor tweak will get you a tax strategy. Or if you shift some things around in this area, you'll get benefits from a tax strategy perspective. And so we take our knowledge and their fact pattern and align them as best as we can within the tax code. So, so when you can combine those two elements, it can result in a lot of really beneficial savings to our clients.
Yeah, and I love that you mentioned that. It's been a while since I've read that book, but I do love that. Begin with the end in mind. Have a clear picture of where you want to be. Have that goal in mind of
Hmm.
what you envision, and that gives you the best odds and the best ability to plan to be able to get there in the end. So I really love that, and I
And
feel
I
like,
will oh,
100%.
yeah.
sorry, I'm gonna jump in. I will say that, like, that's one of the things I think that makes our firm unique is just that forward thinking, goal-oriented, partnership with our clients. And that's how Caleb and I complement each other in that, I work with business transformation and my background was entrepreneurship. And so pairing those things together to really serve our clientele, it just brings this unique lens that is not maybe as flat as just looking at data. We're looking at this holistic picture and wanting to propel people forward in their goals and dreams, and leverage cash flow to do that by saving taxes on taxes. So
Yeah, absolutely. And I mean, it's not like you're ignoring the data in the past. You're using the data in the
no,
past
yeah.
and the picture of the future to be able to pave that path, right? And I think that's
Hmm.
awesome. And I think what we're really talking about here is really moving away from investors, because I think so many of them and so many of us do at times is thinking of taxes as a once a year, oh, I just remembered I have to file with my
Mhm.
CPA. event, right? And or something that just even gets filed after the fact, but something that I feel like we're discussing and that your firm talks about from looking at your background is being proactive and really tax planning all year and painting that picture and working on that and taking the steps, staying on that path really, I guess, that you're paving for them. So in practice, I guess my question would be, what exactly does that look like when taxes aren't just a once a year thing, when it is this all year planning, this all year
Mm.
procedure?
Yeah, so it kind of varies depending on the client. So I'll give you two answers to that. Usually, most of our clients, especially in tax strategy, are business owners. And that's largely because most of the tax code is geared towards incentivizing business owners. They bear more risk in the economy compared to a W-2 employee. And so the IRS incentivizes them for that risk. There are more deductions they can take advantage of. There are more tax strategies they can take advantage of. And so many times a business owner will come to me and they'll say, we're going through these changes in our business, where we're trying to allocate our money better for long-term asset growth versus always paying taxes. And maybe they're wanting to look outside of investing in their business for some of this wealth building. And so usually in that situation, it's a one-time build or tax strategy that we put together for them. And we say, okay, this is where you're wanting to go. This is what you have going on right now. Let's mesh the two of those and see what comes out. So we meet with them and we understand all of those drivers. And then we come back to them afterwards with a tax strategy and we say, implement this over the course of the year. We'll be here to help you. The second, I guess, track that I would take or that we do take with some of our business owners is really for business owners that are more in growth mode. They might have more assets, more wheeling and dealing, and they want to meet more often than just that one time tax strategy meeting, or however many meetings that tax strategy turns out to be. It's more than a one-time event because throughout the year they are buying property, they're selling property, they're thinking about investing in a business and want to know the tax implications of that. And so I call it hyper growth mode. There are other terms out there, but they're really focused on a number of transactions that have a tax impact and they want input into that.
That track also would apply to our high net worth clients that may not always be in business owning or CEO mode, but they're overseeing a lot of transactions or like your family office type situation, where they're trying to employ their capital very uniquely. That's also the track that Caleb's referring to here.
And that's nice too, that that you can have, this flexibility to serve the clients who maybe just need that initial planning session, and then the ones who you mentioned are in super that hyper growth mode that you mentioned.
Yeah, absolutely. Different owners, business owners have different needs. And so we try to meet them at their point of need with those offerings.
Right.
That's
And
awesome.
throughout the year, I would say to your point, Nick, it really looks like a partnership. And having a regular cadence to meet together and stay aware because oftentimes, the clients they don't know what they don't know, and they don't know that some of their ideas and thoughts and plans are actually going to have tax implications. And so having a regular cadence of just discussing life and where they're headed with their goals and accountability measures or KPIs we're tracking with is going to give us insight to say, oh, there's a little nugget of information that we want to catch and use to your benefit, and can offer that throughout the year. Whereas if we're not talking, but once a year to prepare for filing the tax return, you miss those opportunities to bring your knowledge to bear in the client experience.
Yeah, absolutely. I would definitely agree with that. And and I kind of want to bring it into more specifically and kind of put under a magnifying glass how tax strategy can increase your investable capital, especially like we mentioned, if somebody is building a business, maybe they're branching into
Mhm.
alternatives like real estate, private equity, or other early stage opportunities. Let's dive a little deeper into how tax strategy can increase your investable capital.
Yeah, sure. So I want to say something first at the outset that one of my old mentors used to say. He would say, "Don't let the tax tail wag the business dog." And by that, he meant don't let the taxes change your business decision just to get the tax situation or the
Mm.
tax advantage. And I always want to put that out there with my clients because some of them say, I don't ever want to pay taxes ever. I want my tax rate to be zero. And okay, well, the most common scenarios where I see that no taxes are paid are you're not making very much money. And most people don't want to make much, most people want to make money. Or sometimes there's fraud, and I don't want to have any piece of fraud. And then thirdly, business owners that are highly active will go through cycles and they'll have some years that are higher income and they'll pay more taxes, some years that are lower and they'll pay lower in taxes. They might even pay zero in some years. And we can work with that. There are opportunities there. So what I tell my clients is I want to try to get them out of the top tax brackets if there's any wiggle room. And so we look at clients that are in the 37% tax bracket plus the NIIT tax that gets you closer to 40%. And how can we save them tax dollars at that top tax rate? And so when we develop a tax strategy with them, there are many cases where the tax savings that they get from our tax strategies can help offset the cost of the investment that they made in those tax strategies. So what you're doing in that scenario, and we do this with real estate, we do this with other tax strategies, what you get in that scenario is a snowball effect or a compound effect of the tax savings that they're getting. So if I can save them 50,000 in $50,000 in taxes or $200,000 in taxes in 1 year, and they invest that in the next tax advantaged asset, they can repeat that and they can just start start gradually growing their wealth. And the more they do it, the faster that wealth can grow. So that's kind of the approach that we take. We don't try to bring clients to zero in most instances, but if we can save dollars at those top tax brackets, we can really get them to start experience a compounding effect of their wealth creation.
Yeah, it's all about leverage and reallocating the dollars that would have gone to the IRS legally to other strategies.
We always want to do it legally, but yeah, I love that it really seems like you're just trying to cash flow whatever tax savings you have
Mhm.
into other, performing areas. So I think that's awesome. And while we're talking about, not letting your success, that cash flow go to the IRS, from the standpoint of somebody who's allocating capital into these alternative assets, I feel like taxes can quickly drain gains if you're not intentional, like we've talked about. Just with your
Mhm.
experience, what would you say are some of the most common ways that you've seen
Um,
like high performing investors overpaying in taxes, and how do you get ahead of that, or how do you intercept that?
Yeah, that's a great question. And I love how you used our tagline, "Don't let your success go to the IRS."
Had to throw it in
We
there.
that's a that was that was good. So how do high net worth individuals or hyper active or hyper busy business owners overpay for taxes? I would say that the biggest way that I see them doing that is when they're only focusing on growing the business. They're not focused on being strategic. They're not focused on taxes. They're not focused on wealth accumulation. They're only focused on growing the business.
Mhm.
And at some point, you might see some benefits from that. You might try to sell the business and make a ton of money, but you're also going to be taxed on it if you didn't structure it the right way. So that's probably the biggest impediment, is just that they're not being proactive in their thinking. They're not being strategic. They're not reaching out to experts and tax strategists to tell them what to do. They're solely bringing in active income and not investing in anything that will bring them passive income or portfolio income that is taxed at lower rates, and that they can get compounding benefits from in the future, is just the focus on solely building the active income.
I really like that, and I think a lot of our investors, a lot of our listeners, I should say, are I'd say 80% of people who are using self-directed IRAs that we set up or investing personally and are listening are investing in real estate. Are there r- specific real estate strategies, as opposed to? I know we've been talking a lot and speaking a lot to the small business owner, which a lot of our clients are as well with the solo 401ks that we set up. But on the real estate side, does it I'm sure it does look different because it's a different asset, um, it's a different investment. Can you speak a little bit to, specific real estate strategies, when it comes to tax savings?
Yeah, absolutely. And the overarching theme for this is that the IRS has decreed three buckets basically of income. And we've talked a little bit about active income. Active income is what you get from a W-2 job or from being active in a business. Active income is taxed at the highest tax rate. You also have passive income, and this is where real estate comes in, and I'll answer your question more fully. Passive income is where you're not actively working in it. You're investing in it on the side. It might be a business, it might be real estate, it might be royalties from oil and gas, but you're not working in it for the most part. And there are definitions. I don't want to get too much in the weeds for our audience, but there are definitions of what active means that gets into the material participation rules. And then thirdly, there's portfolio income, which you would think would be passive income, because it refers to stuff like interest income, dividends, capital gains from stocks and bonds. That sounds passive to me, but the IRS has this third category for it. So what we're trying to do is get some of the income into the passive bucket, because the passive bucket is going to be taxed less than the active bucket. Also, portfolio income can be taxed at a lower tax bracket. And so those are kind of, we're trying to get our clients to start shifting the sources of their income into these passive and portfolio buckets. As far as tax strategies for real estate, and one of the reasons why it can be so beneficial from a tax perspective, is you can get benefits from short-term rentals, and there are ways to offset that income with your active income within the tax code. And there are 1031 exchanges where someone can exchange, or sell one property, roll the proceeds from that into a newer, better property, and not pay any tax on that exchange. And then eventually, whenever they pass on, assuming they're building legacy wealth here, whenever they pass on and the asset goes to their children, that asset can be stepped up to the basis at their date of death, or the fair market value of that property at the date of death. And so if you get into a situation like that, thinking about the life of that asset, it could have grown hundreds of percent in value, and you're never paying tax on it because it passes to the children at the fair market value basis, not the basis that was originally put into it. So there are a couple. You also have cost segregation, which is an engineering study. We work with engineers on some of these tax strategies to make sure that we're getting that compounding effect of the tax savings that we talked about earlier. And there are ways to offset the losses with long-term rentals, depending on how someone's asset allocation looks. So it's probably the most tax advantaged asset class within the tax code is real estate. When you know the pieces and you can figure out how to put the pieces of the puzzle together for the clients to get the most tax benefit.
I love that, and it makes sense why real estate has been, that foundational asset for a lot of people building
Mhm.
wealth, with all the strategies that you mentioned, and just um, the way that you can make those tax savings work for you and continue to compound, like we talked about. I love that. With the strategies that you have in general, is there one strategy that you have that you find that people don't think about until it's too late, or maybe they procrastinate and they come to you guys and unfortunately, like if you would have done when's when's the best time to plant a tree? Well, 20 years ago. When's the second
Mhm.
best time to plant a tree now? So what's one strategy that you feel like people don't think about until it's too late?
Well, I would argue that most of them are, uh, but I'll give you the biggest dollar value one probably that I've seen, and that's it's gotten popular on social media. There are pitfalls that you can fall into, but it's the QSBS stock gain on stock exclusion. It's a qualifying small business stock is what QSBS stands for. And people who have been in the profession for a while might say, "What's that? I've never heard of that." It used to be called the Section 1202 stock exclusion. But that sounds a little bit more technical than QSBS. So same thing. Basically, what it does is when you sell the stock of a C corporation to a new owner down the road, whenever you're done with the business, there's a way to exclude up to $10 million of the gain on that sale. And recently, when Congress passed the most recent tax law change, the OBBB Act of 2025, they broadened the opportunities to qualify for that exclusion. So now individual owners can get up to $10 million of gain exclusion. And there are
Wow.
certain requirements you have to work through. There's certain things that break that exclusion. And so you really have to work with a professional to make sure that you are able to maintain that and get the exclusion when it matters most at the time of sale. But I had one business owner come in last year and say he sold his business, and I can't remember if it was him or one of his fellow stockholders, but they said they weren't able to take advantage of the QSBS exclusion because of something that had broken down in the securities over time. And
Mm.
so they ended up paying millions of dollars in taxes that they could have avoided if they had preserved the integrity of the Section 1202 stock exclusion.
And
That's probably the
wow.
biggest one. But honestly, I would say, any tax strategy that's missed is there are reasons why it gets missed. It's an oversight that a business owner usually doesn't keep track of tax strategy unless they're working with a tax strategist. So
It kinda goes back to what I was saying previously, the clients just they don't know what they don't know, and
right,
you really
yeah,
do need that partner to come alongside you to advise and keep an eye on things and bring their knowledge to bear, almost like a coach in a way, but definitely we really value that partnership, here at our firm.
Yeah, I love that. And just to bring it back, so you said it's a 10 million exclusion. Is that just like 10,000 off the top that you're not paying in regular capital gains tax? Am I understanding that right?
right. So
That's
ten
crazy.
million dollars of the gain on the sale of the stock in the company is excluded. So most people are familiar with if they sell their primary residence, they qualify for an exclusion on the gain. That gain exclusion is $250,000 if they qualify for it, $250,000 for a single person, $500,000 for a married filing jointly couple. And that's dwarfed by this $10 million exclusion.
Yeah.
Obviously, you have to own a business to qualify for it,
Sure.
but much more substantial gains that are excluded from capital gains tax.
But yeah, I mean, if you do own a business, missing out on that's such a crazy amount to just have to just not be able to sweep, under the rug. That's I just had to make sure I understood that right, because that is a big deal for sure,
Right.
especially when you're selling a business. Um,
Absolutely.
um, so looking with what I'm thinking our audience would typically ask, when does it make sense to step outside of stocks and bonds into these other, private assets like private equity, real estate, direct business investments, small business investments?
Man, that's such a good question, but I could take it so many different ways. So, one of the reasons that my wife and I bought this business was to start our own wealth accumulation. And there's, as you probably know, working in the stock industry and advising, there are different levels of business size that graduate you up or scale you down in terms of multiples of EBITDA. So I could take this many different directions. Do you have a preference?
Let's go with, and I think you cut out there for a second, so I missed the first part of that. But let's take it in the most confident direction that you have.
Okay. So I think there are a lot of opportunities for individuals and couples to invest outside of the stock market. And usually, what I see for that is that it's people that are more willing to be, I guess, involved in their assets versus just setting them and forgetting them in the stock market. And in exchange for being more involved, they usually get a higher rate of return. So I see this with real estate investors. I see this with business owners. If you're investing in an asset that that you have some control over, you many times you can see a higher rate of return than you'll ever see investing in the S&P 500. And so there are a variety of reasons for this. One is I worked at a company that was middle of the market in terms of capital for the oil and gas industry, and I saw this played out really well in their acquisition and mergers and acquisitions strategy. There was a company that they were thinking of buying, and at the time, they were talking to investors about selling their own stock and selling their company, and they were going to get something like 6 to 8 multiple on their EBITDA. And just quickly for definition purposes for our audience, EBITDA is EBITDA, stands for earnings before interest, taxes, depreciation, and amortization. And so you take out all these, you get to the earnings, and that's one of the most common measures of what investors will pay for in a company. So this company that I worked at, they were talking to investors that were going to give them about a 6 to 8 multiple on their EBITDA for the year. But if they bought this other company and vertically integrated it into their own company, so they were supplying referrals to each other as well as parts uh, and supplies between the two companies. And if they did that successfully, the combined companies could sell for 10 to 12 times multiple of their EBITDA just by integrating, not by changing their business, not by any additional savings. And so I saw in that model that if you're building a business, you're going to get more as you grow it compared to keeping it small. So back to your original question, if there are people that are thinking about are wanting to really grow their wealth rapidly, investing in a business and growing the business and possibly multiple businesses is one of the fastest ways that you can grow your wealth. Now it is leveraged, meaning that it can more quickly propel you up, but it can also more quickly can propel you down. And so you have to be really careful and take an assessment of your own skills, your own abilities, your own bandwidth, both personally and as a family before you take something like this on. But because I've seen it go the other way as well. But that would be kind of what I would be looking at. Are they trying, is someone trying to build a legacy for their family or generational wealth? Or is there some kind of other external reason or
Mhm.
motivator that's wanting them to increase their income and their wealth? Buying a business and buying into real estate can really help you get there faster.
Yeah, I think that's really the allure of alternatives like, small business investing, investing in businesses, real estate. It is that I mean, maybe that higher risk, but that higher reward at the end of the day, and being able to, like you
Right.
mentioned, generate wealth uh, a lot more quickly than you would be able to in any public markets. From your perspective, we've talked about how tax strategy can accelerate wealth. Do you feel like tax strategy can accelerate readiness, like your personal readiness to invest in alternatives? Like if you were thinking about it and you're right on the cusp of wanting to jump into it, do you feel like having a tax strategy can accelerate um, your ability to be ready and be prepared for alternative assets?
I I'm not sure. That's a good question, but I think that uh, I think that people need to be aware of their own uh, bandwidth in life. You know, if you have young if you're married and you have young kids, it can be a lot harder to get involved in business, for example, especially if you're starting or buying an existing business versus if you're younger and don't have kids or you're older and your kids are grown. My wife and I have 4 kids, so
Awesome.
we're familiar with some of those determinations that need to be made. In terms of a tax strategy moving you towards readiness, I would say that it can be more of a coaching indicator. So if you work with a tax strategist and they say, invest in this asset class and you can see more tax savings and more benefit, I think it could get you more towards what you're going for. But I, I, I would hesitate to use the word readiness for those reasons that I mentioned earlier, if that makes sense.
It goes back to kind of our differentiating quality here in that we really look at people holistically and our clients holistically. So we're asking them these kinds of questions and helping them think through um, these other aspects of their life and their overall life goals, and even identifying them if they didn't have them, um, because other CPAs, other tax strategists are going to just deliver you the plan, and
Hmm.
the consequences may not have been communicated. All of these things take effort, and so yeah, just I think Caleb's speaking to the way we view things differently here and how we help our clients differently.
Yeah, and I was
Nick,
gonna say Yeah, I was gonna say that partnership mentality and the fact that it is this relationship where you have this open line of communication, I think really does
mhm,
play into walking through somebody and really helping them discover if they're ready or maybe if there's, steps that need to be
Exactly.
taken.
right.
Yes.
For sure. Nick, I'll say a couple of my clients that probably love me the most right now is for are or the reason they love me so much is because I told them don't buy a business or sell a
Yes.
business.
You keep people okay, yeah, it goes both ways, yeah,
Right.
get into this investment or don't make this huge mistake. I mean, I feel
Absolutely.
like that's what a real friend would
Exactly.
tell you, that's what a real partner would tell you to save you the headache, save you the financial pain, obviously, and the Yeah,
Right.
I love that. That
And we've
it's
had
not
some
just
people come back and say who didn't listen and say, "I wish I had."
Mhm.
Right.
Yeah.
So,
I wish I had listened to you, but yeah,
yes,
it goes
yeah,
both
Yeah.
ways.
yeah,
It's helping them prepare for the wins, but also keeping them from, jumping into the losses or those bad situations. I think people don't
Absolutely.
think about that all the time. That's interesting.
Yeah.
well, it's
Um,
it's kind of what Caleb said earlier. It's like you can propel, higher more quickly, but you can also crash
Mhm.
and burn more quickly. And so
right.
there's this kind of risk mitigation even in the advice we give that we want to help them succeed. That's our goal. And so if we think the risk is pretty high that they're going to actually crash and burn by implementing something too quickly, we want to be
Mhm.
upfront with that and help them to avoid that, propelling them
A
downward.
rapid, yeah.
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 We
Right.
want to stay out of the toilet spiral for sure when it comes
100%.
to financials. Yeah, we want to avoid that.
I
Um,
like that.
we've talked about, broadly the service that you offer of tax strategy, how that plays into this. What what do roles I mean, what roles do these smaller things like bookkeeping, maybe CFO level insight play in reducing risk in these strategies, if any?
Yeah, so we do offer full range accounting and tax compliance and tax strategy services for small to mid-sized business owners. And one of the reasons for that is if we know they have a clean set of books, we can rely on them more. We have some
True.
clients who bring in their own financials and they say, I don't remember when's the last time I reconciled these. And we can't rely on that. And it raises audit issues for them with the IRS, and it
Mhm.
doesn't really
Mhm.
present a good picture for what kind of tax strategy opportunities there are. And in some cases, we can't even work with them because if you can't rely on the books, you can't really prepare a tax return.
Yep, that makes sense.
So, so I kind of look at it as the bookkeeping that we do or another accountant does, that's laying the foundation. That's giving us substantive data that we can look at and see what the opportunities are and see what the possibilities are. And if that's not there, the client is at greater risk of running afoul of the IRS, greater risk of not being efficient in their financial movements and liquidity. And so it lays the groundwork. Good books, good financials lay the groundwork for good tax strategy, good advice, and even building good metrics like we were talking about with CFO fractional services.
I love that, and I love how you frame it as laying the groundwork. It's really part of paving that path to that goal or that whatever your clients are trying to reach. It's just a
Mm.
part of laying those bricks, paving the path to that success, whatever that is for them. I love
And
that.
one of the things that we enjoy about kind of keeping both aspects in-house is that, with our team having eyes on the books, oftentimes we stumble into something that the client didn't even think of telling us. That like
Mhm.
research and development costs or these sorts of things that we discover in the books, or if we did something slightly differently for them, that would filter up to those higher level decisions and make a big impact. And so when we can discuss that all as a team, on a client basis, that's really helpful versus communication getting lost between just ownership issues or accountants elsewhere and our advisory services.
I love that, and again, really grateful to be able to have both of you on here today, sharing these insights, sharing your experience and what you've seen from the working side of tax strategy. Um, before I let you go, is there like three practical steps? I mean, it doesn't have to be three. Is there practical steps that our listeners can take in the next 30 to 60 days to tighten up the tax strategy, preserve more capital for growth, and for investing in alternatives?
Yeah. So I think that one is really understanding what kind of investor you are. And there are good tests out there that can measure your tolerance for risk, your desire to be more hands-on versus hands-off. There's a study that talked about the types of millionaires that you see and how many of them are more focused on saving and accumulating. Some of them are focused on entrepreneurship. Some of them are focused on, I think they had two other categories. But those two, that determination is really significant in terms of what types of assets you want to invest in. So if you're more of the saver and the investor and you want more measured growth, you don't want to take on risk, alternative asset classes are not really generally for that type of investor. And along with that, your tax strategies are more limited. It's just there's not much you can do from a tax strategy perspective with a W-2 job with someone that's just wanting to invest the max in their 401k every year. Now you can accumulate wealth, but and and I don't. Let me see. I do work with some of these kinds of clients, but I just have to temper their expectations. We're not going to be coming up with this. Uh, Go and invest in a business or go and invest in real estate if that's not their investor profile. But if we have investors or people that are much more active and want to be involved in building legacy for their family, they're okay with owning a business. Maybe they already are part-time in one and are trying to figure out how to go full-time, or they sold one or they moved out of one of their homes in the past and they turned it into a rental and they're thinking about doing more than that. Those situations are ripe for tax strategy. And so I think first, in answer to your question, what to do in the next 60 to 90 days, understand yourself. That goes back to all sorts of philosophers that talk about how knowing yourself will provide you so much more in life than if you don't know yourself. So know yourself first, and again, that's kind of foundational. Then you can know better if alternative assets are for you, or not. Because I would much rather work with, I don't know about you, Nick, but I would much rather work with someone who's taking on the challenges and stress of real estate and business ownership proactively and wanting to really grow something that they can look back on in the future and be proud of, or they're trying to grow something for their kids, than someone who bought a business because they thought it would provide better returns than the stock market, but really isn't cut out for it. It's just much harder to provide value in that case, much harder to really align with the vision if they don't really have one per se, other than growing their investments. Did I lose connection there?
I think we did for a minute, but I can go ahead and just echo the last thing I heard you say is, yeah, I would definitely rather work with somebody, especially with the plans that we set up. It's really similar with the self-directed retirement plans that allow people to invest in alternatives. It's a
Mm,
amazing strategy. It can be like a defining factor for how you're building wealth in your life, if it's right for
right.
you, and that's a big if, right? And like you said, I think
Mhm.
that foundational step that you talked about, knowing yourself and knowing if this is the right strategy for you, if the self-directed plan is right for you, or if this certain tax strategy is right for you, if investing in business is right for you. It all comes down to, like you said, knowing yourself, knowing what is going to accelerate your ability to generate wealth. So I agree with that wholeheartedly.
That's great. Yep.
Uh, um, yeah, I that's again. I can't think of a better note to end on there. Again, so grateful for your time coming on today, talking with our audience. One thing I want to do is just give our listeners any information they need to be able to connect with you, resources for content if they want to see more stuff from the Helms and Helms tax strategy. Where can they go?
You can definitely go to our website, helmstaxstrategy.com. We have a couple of videos up there. One is a client profile. I think they're on YouTube as well, but we're really now beginning to build our online presence. And so just stay in touch, on all the places, Facebook, YouTube, Instagram. You'll see more. But our website is the main spot right now.
Awesome. Yeah. Thanks again. Everybody go check out Helm's tax strategy if you like what you heard today and if you're wanting more of these insights. I can't think of any more qualified people to work with. Go check them out. Hope, Caleb, any last advice, last word you want to leave with our listeners here today? Favorite quote, anecdote, joke?
But Nick, it was a pleasure talking with you today.
Yes.
It sounds like we have a lot of shared goals in partnering with our clients. So I think that this has been really good, and I appreciate the time. So I wish I could come up with a joke. One of my sons was asking just the other day, "What's the best joke you know?" But I don't have one at the tip of my tongue.
Yeah, I got too many tax strategies up here. I don't have room for jokes.
That's
There's
exactly
no
right.
room for
Yeah.
jokes and tax
It's not the
strategy.
weekend. It's tax season.
Exactly. It's working time. It's time to put your yep, I love it. Awesome. Well, thanks again for coming on. Thanks everybody for listening, and we'll see you next time.